Welcome back to the channel. I'm Algabot, your guide to automated trading systems, and today we are studying an expert advisor for MetaTrader 5 called Volume Weighted Median Reversion. This is a mean reversion strategy built around a very robust idea of fair value. Instead of an average that a single wild bar can distort, it anchors to the volume-weighted median of price, a genuine balance point where half the traded volume sits above and half below. In the next few minutes, you will learn how that anchor is built, how the strategy decides a market is balanced, and exactly when it looks to fade in overextension. Let's dive in. Let's start with the big picture. Volume-weighted median reversion is a counter-trend, mean reversion strategy. The core concept is that in a balanced or ranging market, price tends to oscillate around a central fair value, and overextensions away from that value tend to snap back toward it. The question every reversion strategy must answer is, what exactly is fair value? This EA answers it with a volume-weighted median. Here's why that matters. A traditional VWAP is a volume-weighted mean or average. The problem with an average is that one climactic bar, with a huge range and huge volume, can drag that average toward the extreme at exactly the moment you most want a stable reference. The median does not have that weakness. It is the price level at which half of the traded volume sits above and half sits below, a true volume balance point that barely moves when one outlier bar prints. By weighting the median with tick volume rather than taking a plain median of price, the strategy anchors to where liquidity actually changed hands, giving a more grounded equilibrium. The strategy uses the average true range, or ATR, as its volatility yardstick. ATR does three jobs here. It defines how far price must stretch from the median to count as a meaningful overextension. It measures whether the median anchor itself is drifting or flat, and it sets the protective stop distance. Because everything is scaled by ATR, the system automatically adapts to quiet and active conditions. This approach is best suited to traders who are comfortable with counter-trend, range-based systems, and who understand that mean reversion aims to catch the return to balance, not to ride a trend. Its natural home is a liquid foreign exchange major or a stock index, on time frames from the 5-minute up to the hourly chart, where volume balance reversion tends to be most pronounced. As always, this is educational information only, and trading involves real risk, including the risk of loss. Now let's walk through the exact logic, step by step. The EA works on closed bars only, acting once per newly completed candle, so it never reacts to an unfinished bar. First, it constructs the fair value anchor. Over the last 40 bars, by default, it takes each bar's typical price, the average of the high, low, and close, and weights it by that bar's tick volume. It then finds the price level where the cumulative sorted volume first reaches half of the total. That level is the volume-weighted median, the strategy's center of gravity. Second comes the regime gate, and this is the filter that keeps the system out of trends. The EA measures how far the median has drifted over the last 20 bars. If that drift is smaller than the FlatRegime multiple 1.5 times ATR, the market is judged balanced and reversion-friendly. If the anchor is sloping steeply, that signals a trend, where fading moves is punished, so the strategy simply stands aside. Third, the strategy checks for a meaningful overextension, which it calls stretch. The bar must close at least the stretch multiple 1.8 times ATR away from the median. That distance self-scales with volatility, so it stays statistically meaningful in both calm and busy markets. Fourth is confirmation of reversal. The strategy does not fade a still extending move. For a long, the overstretched bar sits below the median but must close bullish, above its own open, confirming the first tick of reversion. For a short, the bar sits above the median and must close bearish. When all conditions align on the long side, the EA signals a buy. The take profit is set to the median itself, the balance point acting as a magnet, and the stop loss is placed the stop multiple 1.6 times ATR below entry. The short side is a mirror image. Sell, target the median, and place the stop that same ATR distance above entry. Before any order, a minimum reward to risk filter of 0.7 rejects setups where price is already too close to fair value to justify the stop, and a spread filter skips entries when the spread is too wide. Only one position runs at a time. Let's read through the meta editor code on screen. At the top are the input parameters. Median period, 40, sets the window for the volume-weighted median. StretchAtrMult, 1.8, is how far an ATR term's price must close from that median. Regime loopback and FlatRegimeMult, 20 and 1.5, define the flat market gate. ATR period and ATR stop multiple set the volatility measure and the stop distance. Min reward risk, 0.7, and max spread points, 80, are the quality filters, and then we have lots and the magic number. Now the long block. The condition reads, if the closed bar's close is below the median minus the stretch and the bar is bullish. When that is true, the entry is taken at the ask. Look at how the exits are set. The take profit, TP, is simply the median value itself, the volume balance point acting as the magnet. The stop loss, SL, is entry minus the stop distance. The code then computes reward and risk and only calls trade.by when the reward-to-risk ratio meets the minimum. The short block is the exact mirror. If the close is above the median plus the stretch and the bar is bearish, the entry is taken at the bid. The take profit is again the median, and the stop loss is entry plus the stop distance. After the same reward-to-risk check, the code calls trade.sell. Both sides target the same central fair value, and both are protected by an ATR-based stop. Let's bring the logic to life on the chart. The blue line running through the middle is the volume-weighted median, the strategy's fair value anchor. Notice how flat it stays across the whole sequence. That flatness is exactly what the regime gate is checking for, and it tells the strategy this is a balanced market where reversion is worth trading. The two gray lines above and below it are the stretch bands, sitting 1.8 times ATR away from the median. Price has to close beyond one of those bands to count as a meaningful overextension. Watch the opening candles. Price begins near the median and then rolls lower, candle by candle. On the second candle, it pushes down hard and closes below the lower stretch band. But look closely, that bar is bearish, still falling, so the strategy holds its fire. It refuses to fade a market that is still dropping. Now the next candle is the one that matters. Price is still stretched below the lower band, but this candle closes bullish, above its own open, showing the first sign of reversion. That is the full recipe: a flat median, a close beyond the lower band, and a bullish confirmation bar. The strategy signals along, and you can see the buy entry marker appear. The take profit is set at the median itself, and the protective stop sits well below, at 1.6 times ATR under the entry. From there, follow the recovery. The market lifts off the lows and climbs back toward fair value, one green candle after another, drawn like a magnet to the median. When price reaches the median line, the take profit target is met and the long is complete. The trade did exactly what a reversion setup intends. It captured the snapback from overextension to balance. Now the chart sets up the mirror image. Price does not stop at the median. It keeps pressing higher, and on the ninth candle it pushes above the upper stretch band. The very next candle closes bearish, rolling over from above the band while the median remains flat. That satisfies the short recipe: an overextension above fair value, a balanced regime, and a bearish confirmation bar. The strategy signals a sell, and the sell entry marker appears. Again, the take profit is the median, and the stop is placed 1.6 times ATR above the entry. Then price eases back down, candle by candle, gravitating toward fair value once more. When it reaches the median, the second take profit target is met and the short is complete. Notice the symmetry. Both trades faded in extreme, both aimed at the same central balance point, and both required the market to prove it was reversing before the entry fired. And remember, the reward-to-risk filter of 0.7 would have rejected either setup if price had been too close to the median to justify the stop. This is a clean illustration only. Real markets produce setups that fail, so risk control always comes first. So there we have it. Today we explored volume-weighted median reversion, an expert advisor that anchors to a robust volume-weighted median as its fair value, filters for flat and balanced markets, and fades overextensions only once price begins reverting toward that center. We covered how the median resists distortion from spike bars, how the ATR-based stretch and stop work, and how the median itself serves as the take-profit target. Remember, everything in this video is educational information only, not financial advice. and not a recommendation to trade. All trading carries real risk, and losses are part of the process. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with strategies you would like me to cover next. You will find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.